Accounting 18, managing cash using a cash budget. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email and our phone number. You will also find us on Facebook at St. Louis Test Preparation, St. Louis Test Prep, which is our Facebook page. And you'll find a related video on the same subject, Management Accounting 7. This cash budget process relates to the accounting cycle, money coming in and out of your business. So for example, let's say it's Levi Strauss, the jeans maker. They make blue jeans. They spend cash on material, which might be denim, on labor, paying people to sew the blue jeans. They manufacture a good, a pair of jeans, or perform a service. They deliver that product or service and bill the client. Maybe they ship jeans to Old Navy, and they bill Old Navy. Subsequent to that, Old Navy, the client, pays them cash, and they collect cash. They're going to take that cash and use it in part to buy materials and labor again, and the whole process repeats. And oftentimes, I found that most companies do not succeed because they're not profitable. Most companies don't succeed because they don't have enough cash. So you can imagine that if you're a business owner, and you've invested cash in your business, and 6 months go by, and you look at your balance sheet, you're going to wonder where your cash went. That cash, most of it is going to be accounted for in the asset section of the balance sheet. Your cash is going to be tied up in receivables, sales that you've made to people, and in order to sell something you had to make something, and you paid cash to make something, and you haven't been paid yet. So receivables is a large part of your balance. And if you're a retailer or manufacturer, another part of your cash balance is going to be tied up in unsold inventory, goods waiting to be sold. And you'll notice in both of those that both of these are related to sales. And then if you sell more but don't collect as much, there's going to be a cash drain on the business. Selling more is not necessarily good if it drains all your cash. I've jumped over to Microsoft Word, and I have an example problem that I want to use to explain a cash budget. Bob Gateway is the manager of a gift shop, and he wants a cash budget showing expected cash receipts and disbursements for the month, and a cash balance at the end of the month, which in this case is April. So he's got a beginning balance in cash right here. And then in the next bullet point, he has receivables for things that he's already sold. He's got some receivables that total $530,000, $80,000 of which is from February, $450,000 of which is from March. And the problem is that he doesn't collect all the cash immediately. Some of it he collects in the month of sale, 40% in the month following the sale, and 10% in the third month, which can also be stated as the second month since the sale took place. If I jump over to Excel, here's my Gateway News and Gifts cash budget. Here's our beginning balance of $100,000, and then I'm going to add cash collections. We will find out at the end of the Word document sales in February, March, and April. We collect 10% of the February sales in the second month after the sale, and we're all done with collection for February. 40% of the March sales, and 50% of the sales we made in this month. So you can see that these are positive numbers because those are cash dollars coming in the door. Accounts payable at March 31st, $460,000. I'm assuming for my model that none of that payable is paid in cash. We purchase things for our business. We make merchandise purchases to stock the shelves at the news and gift shop. We spend $450,000, but we don't pay it all at once. 40% is paid in the month of the purchase, 60% paid the next month. And then finally, you'll see that we have payroll due in April of $90,000. Flipping back to Excel here, here's 40% of our April purchases, and here's the $90,000. Again, it's a negative going out the door due in April. We have other expenses that we pay in April totaling $45,000. And then we have an accrual. We have accrued taxes for April, but they're not payable until June. So from a cash basis, there's no impact for the accrued taxes. That happens later. It's an expense now in April, but the cash doesn't go out the door until June. We have a bank note that we have to pay April 10th, $90,000 principal plus $7,200 interest. And then we have depreciation for April of $2,100. Depreciation is a non-cash expense. When your car depreciates, you're not writing a check every month or every year for depreciation. It's a non-cash expense, so it doesn't affect our spreadsheet. So you can see on the schedule here, here's the $97,200 principal and interest going out the door. And here are the other expenses, $45,000. Finishing up the Word document, we have an insurance policy due April 14th for renewal. We're going to pay $1,500. We sell some stuff in April, $1 million in sales, and we collect half of it in the month of sale, which we've already seen, but I'll point out again. So to finish up the sheet, here's 50% of the $1 million in sales in April. Here's the check that we pay for the insurance policy. So if I add all this up, and I go to my summation column here, you'll see that I have an ending cash balance that's much higher, $374,000 plus in total dollars. But there's an issue, and I put it in red here. The issue is that you have a large unpaid receivable balance that you have, quote, pushed back into May. So while your cash balance is higher, you've got a big payable balance that you're going to start off with at the beginning of May. Jumping back to our Excel spreadsheet, our PowerPoint spreadsheet, what I'd like to emphasize is, once again, selling more stuff does not necessarily mean more profit, and selling more stuff does not necessarily mean you're going to collect cash at the same rate. If your sales increase 300%, but your cash collections only increase 100% or double, you're having more and more money tied up in receivables. The more you sell, the more money in dollars is tied up in receivables. So you have to think about whether you can afford, whether you have enough cash to sell more and wait on getting paid more and more often, which ties up more and more dollars in receivables. Because what you're doing is you're creating a potential cash drain in future months. That's the end of part 18. You will see our essentials in management accounting, essentials in cost accounting, which are our 1-hour classes. You can find those. We use GoToMeeting.com for those, and there's videos on YouTube to explain them. Here's our YouTube channel, Ken Boyd STL, all one word. To register for live one-on-one tutoring and chat sessions, you can go to GoToMeeting.com. Here's our website, our email address, and our phone number. Thanks very much, and we'll see you next time.